Welcome to the Brokers Podcast, the place where we give commercial real estate investors insight into the New Jersey industrial real estate market. I'm Scott Perkins.
And I'm Todd. We're going to show you the world of industrial real estate in New Jersey, the movers and shakers of the industry, the trends, the prices, the next big thing, all the stuff you can't get anywhere else so you can confidently invest in the market.
So here we go. All right, Chris, it's summer 2023. Things have slowed down a little bit, but not that much. It's really just a usual slowdown. It's not like the last few years where there was a frenetic pace that just kind of went through the entire summer. What has changed in the last few months, considering the interest rates rising and the real estate kind of slowing down, but what's going on?
Yeah, most years it's fast and furious coming into the start of the year, and when you get to summer and July, there's a slowdown. I think this might be the most active month we've had this year so far.
Well, there's a lot going on. There's things that are actually happening in July, and we're pushing into August, and there's stuff going on.
Yeah. So, while people are on vacation, other people are seemingly getting some stuff done, mainly on the sales side. There's been a lot of groups on the sideline, with some dry gunpowder and trying to make sense of this market. There's been quite a few books out, and these buyers are performing, and you're seeing more and more opportunities come out. So, we're seeing deal execution. You're seeing deals at 8A trade, at exit 9. There's a portfolio of properties in the exit 12, 80 corridor coming out. You got some stuff, one-offs on the 80 corridor, handful of buildings in the Meadowlands about to come out, and it's been tricky for everyone to navigate. You have some new entrants that are getting aggressive. There's been a
new entrants, but we really don't know, can these new entrants actually close? We don't know yet, right? So sometimes the tried and true is the one to go with, but there's still people jumping in.
There are people jumping in. I think the most active ones we've seen are names we all know and that are here. But that's continued to be a phenomenon we see, and more books are coming out. And people are seemingly able to buy and execute, and they're at a little more aggressive numbers than I think we thought. And it really is showing the cap rate as a spectrum.
Yes, for sure.
Yeah, I know there was a time when everything was a 3 cap.
It doesn't matter if it was new product, doesn't matter if it was old product, and there's going to be some sort of mark-to-market. It was all 3.
It was all 3.
You just had to hopefully bid higher than the next guy without any comps, and you'd be able to win, but that's not the case anymore.
Not the case anymore. We've seen a new deal that was maybe even a touch above market on a very big number, and that went for a 7 cap.
Right,
and
7. You weren't hearing those numbers a year and a half ago, definitely not.
No, and that is still a basis that I think some people in the market will say, wow, big number. But then on the flip side, anything mark to market under 2 years, cap rate still doesn't quite matter. 2 years remaining. We have 2.8 just traded, and I think you are seeing some groups that are willing to swallow some very, very tight yields for at least a year or two before marking to market, as long as they can, when they mark to market,
they really get that bump.
That bump and stabilize to a yield that makes sense.
Well, some of the sellers are also being a little more reasonable than they were a year, well, not a year and a half ago, probably 6 months ago, because they were wondering, well, I was getting much higher offers a year and a half ago. How come I'm not getting them now? And I think that's gone away, and people know it's gone away. So real sellers are out there now.
Some of them.
Some of them are real, yes.
Some of the sellers refuse to believe they missed the mark, and I think that will continue. But you're right.
But there's some sellers that are selling because they're institutional money that have been hit with redemptions, and they have to sell in order to satisfy that. So that's out there too.
That's out there too, and I think there was a time where there was a lot of off-market, one-off transactions that us personally benefited quite a bit from. But now someone wasn't sure if they were selling, and someone submitted an offer that was crazier than they could believe, and they move forward. Now it seems a little more structured. Hey, we want to sell. Let's put this in a book. Let's see where the market is, get as many eyes on it as we can, and execute. And although it's moved a little bit, at least things are trading. And I know we talked to a handful of these groups who are still chasing these one-offs, and I know a lot of people are having a tough time underwriting, and we were just with some people the other day talking about underwriting negative rent growth.
Which probably won't put him in the winning position, but
No.
maybe they don't want to be in the winning position if they don't think there's going to be rent growth. But some people are putting rent growth in, but it's not what it used to be.
It's not what it used to be, and I think it's changing where you're seeing vacancy go up, but if it's more commodity space, 16 clear, a generic building, maybe the vacancy is going up and maybe it's taking a little longer to lease. We were talking with some groups the other night saying, our stuff's good product and well located and we're almost full.
Right, and there's still rent growth
and
in
we're
that-
still
that
pushing
space.
rents. And so it's weird to have, at the same time as having no rent growth, having a ton of rent growth, just depending on what it looked like. I mean, we're seeing, there's a 2250 deal in Fairfield, which is the highest we've seen in that market.
Right.
There was an $18 deal in Somerset. There was a $19 B deal in Edison. There's 25 in Belleville. This is rent growth, and that's existing at the same time as some people are naysaying and saying the world's dying. And so I think it just depends on what it looks like, in that'll change a lot of how you perform.
Well, I think also the square footage sizes. If you're above, say, 300,000 square feet, the activity has been a lot less.
Yeah.
300,000 and below, a lot more. And
Sure.
For example, you said there were 3 deals out there, or at least requirements for 300,000 square feet floating around.
Yeah, as we record this,
And
it'll
I
be.
think there's another big one out there that you talked about.
Yeah, there's apparently a lease out for north of 1 million square feet, very well located, but I can't give too many details because I know they are adamant listeners of the podcast.
Right.
But I will say that I have no ties to the 300,000 square feet requirements that we're hearing about. So it'll be interesting to see where they land, what it looks like, what the price is. And as some of these deals that are out there, come to completion, we're happy to talk more about it as the podcast continue.
Right, and below 200,000 square feet, or down to below 100,000 square feet, there's still activity there. There's still deals being done, and the rents that are pretty good rents. It's
Sure.
not like they have to cut back on rents in order to do a deal.
Yeah, I just do think there is a flight to quality.
Yeah.
With the smaller spaces. A lot of the 300,000 square foot space, people weren't building that big back when they were building the lesser quality buildings in the 60s and 70s. So, inherently most of the 300,000 plus are newer construction. There's a geographic flight to quality, which I guess we've seen, but there's not as much of a, just product quality, flight to quality, where there is activity in the smaller spaces, but I do think you're seeing people go towards the better spaces. Better spaces aren't sitting, they're leasing up better.
Well, some of the sprawl that happened was really new constructions, but it was in areas that was never industrial before. So that may take a little bit longer to fill those up. But if you're tight to the turnpike, you're probably going to lease that.
You're probably going to do all right. And yeah, so I think that's kind of what we've seen and where we are. It's been a very positive, from the last podcast to now, I think there's been a ton of positive momentum. Which we would love to keep going. And yeah.
So September we'll be back with Carrie.
Yeah.
I think what we'll do for that particular video / podcast is we'll just go right into the Meadowlands. It'll be all Meadowlands all the time.
Yeah, that's
So-
how I like it personally.
So we'll do that for, I guess, September's podcast / video. But until then, thanks for dropping in and listening to the brokers.
Yeah, and if you have any questions about the numbers we kind of rattled off, feel free to reach out. Happy to, talk to any listeners on the side individually and dive into a little more detail.
Okay, sounds good. Thanks for dropping in.
Bye, guys.
Bye-bye.
That's all we've got for this episode of The Brokers. If you liked what you heard, don't forget to like, comment, and subscribe on iTunes, Spotify, or wherever you listen to your podcasts.
Also, make sure to link up with us on YouTube at Perkins Todd The Brokers and on Twitter at The Brokers NJ. Until next time, we'll see you then.